In 1929, the stock market crashed, and it took America 25 years to recover. In 2008, the housing market collapsed, almost destroying the global banking system. But late 2025, we're seeing warning signs that have some of the world's smartest investors concerned. Not just stocks, not just housing, multiple asset classes flashing yellow at once. For the first time in decades, stocks, real estate, and government bonds are all showing unusual stress signals together. The government is $38 trillion in debt. To put that in perspective, that is larger than the entire economies of China and Japan combined. But here's what that means for you. That creates a bill of $110,000 for every single citizen, even the children. The Federal Reserve faces difficult choices. And the smart money, top investors and central banks, are positioning themselves defensively. Today, we break down three major risks converging at once. If you're holding stocks, crypto, or real estate, these are the data points you need to understand. Warning sign. Number 1. Extreme market concentration. You look at the S&P 500. It looks healthy, right? But look closer. Something unusual is happening. The entire market is being driven by just 7 companies. The Magnificent Seven: Nvidia, Apple, Microsoft, Amazon, Google, Meta, and Tesla. These 7 now make up 35% of the entire index, more than 1/3 of the market. Now, to be fair, markets have been concentrated before. In the early 1960s, we saw similar patterns. But here's what makes investors nervous. If the AI hype cools down, if Nvidia misses just one earnings report, the ripple effects could be severe. And these stocks aren't cheap. The market is trading at a PE ratio of 28. The historical average is 15. Investors are paying nearly double for every dollar of profit. Now, some experts argue this is justified by strong earnings and profitability, unlike the dot-com bubble. But others point out that high valuations eventually revert to the mean. Always. But here's what's really interesting. While retail investors are buying, some insiders are selling. Look at Warren Buffett. His company, Berkshire Hathaway, is sitting on a record $348 billion in cash. He's been selling Apple. He's been selling Bank of America. Now Buffett himself has said most of his money stays in stocks and always will. But that cash pile, it's the largest in Berkshire's history. He can't find investments worth buying at these prices. Jeff Bezos, Mark Zuckerberg, and the CEO of Nvidia have also sold billions of their own stock in 2024 and 2025. Are they cashing out before a crash? Maybe. Or maybe they're just diversifying. But the pattern is worth noting. If this was just about stock valuations, we could wait it out. But there's another problem brewing. It's hiding in the buildings you walk past every day. Warning sign number 2, the commercial real estate crisis. Across America, over 20% of all office space sits empty. In cities like San Francisco or Chicago, it's even worse. But why does this matter to you? These aren't just empty buildings. They represent trillions in outstanding debt. Developers borrowed heavily to build these towers when interest rates were near zero. Now, about $1.5 trillion in loans mature in the next 2 years. And many can't pay them back. Because these buildings are empty, they don't generate enough revenue. And because interest rates are high, refinancing is expensive or impossible. This is what experts call the maturity wall. A wave of debt hitting all at once. Who holds these loans? Not the big banks, smaller, regional banks. The same banks where many Americans keep their savings. When developers default, some regional banks could face serious stress. But wait, in 2008, the government bailed everyone out, right? Could they do it again? That brings us to the third warning sign. Warning sign number 3, the debt constraint. Remember that $38 trillion number. It's not just a number on a screen, it limits what's possible. For the first time, the government spends more on interest payments than on national defense. We're borrowing money just to pay interest on the money we already borrowed. This creates what some call the Fed trap. The Federal Reserve faces 2 difficult choices. Option A, cut interest rates significantly to help real estate. That risks reigniting inflation and weakening the dollar's purchasing power. Option B, keep rates elevated to control inflation. That increases pressure on commercial real estate and corporate debt. Neither option is perfect. Both have costs. And history suggests that when governments face these constraints, difficult economic adjustments follow. So, what's the realistic outlook? Nobody can predict crashes with certainty. Financial markets have surprised experts before. But what we can say is this: multiple warning signs are flashing at once. Stock valuations are historically high. Real estate faces structural challenges. And government debt limits policy flexibility. This is why smart money is positioning defensively. Central banks are buying record amounts of gold. Warren Buffett is holding record cash, not because stocks are bad, but because he can't find good deals. Institutions are preparing for volatility. What should you consider doing? First, get out of high-interest debt. That's always smart, but especially now. Second, build a 3 to 6 month emergency fund in cash. Third, review your asset allocation. Are you overexposed to any single sector or asset? And finally, avoid chasing the latest hype. FOMO is how people lose money. Could the economy keep running fine? Absolutely. Could we see a correction? Also possible. The point isn't to panic. It's to be prepared. This is Capital View Explained. Subscribe for more data-driven analysis so you can make informed decisions when markets shift.